All right, we're going to do number 36. So the first thing that you need to do is copy this table. So I've got that, the dates November 30th, December 31st, January 31st. The spot rate 535049, the forward rate 0.52, 0.48, and since the forward rate and the spot rate to January 31st on January 31st would be the same, went ahead and filled that in. So Acct Corporation, based in Champaign, Illinois, has a number of transactions with companies in the country of Mongagua, where the currency is the Hmong. On November 30th, they sold equipment for a price of $500,000. So I sold equipment to a customer that will make payment on January 31st. In addition, on November 30th, which is the same date, we purchased raw materials for a supplier at the price of 300,000 Hmongs. It will make payments on January 31st. So again, the same day. But here's where we really need to stop and pay a little bit of attention. I sold for 500,000, then I purchased at 300,000. So I really have two transactions. So I am in the net of a sale. Okay. So if you notice that I've hedged it with another transaction, 300,000, but I've sold more Hmongs than I have imported. So this is going to be, probably would be better to put, let me pause this, 500,000, okay. So I added this, I had 500,000 in sales, 300,000 in purchases, so my net outstanding is more sales than purchases. So I'm going to collect on my accounts receivable in the foreign currency. I'm going to pay off these, but then I also have to sell that foreign currency. So I'll have 200,000 excess foreign currency to sell. So that's how I'm going to hedge it. To hedge the net exposure in Hmongs, they enter into a 2-month forward contract to deliver or sell 200,000 Hmongs to a current foreign currency broker for 104,000. Okay. So I really wish they hadn't put that. So 200,000 times 0.452 is 104,000. They designate the contract as a fair value hedge of a foreign currency receivable because I have more receivables than payables. The following applies. Okay, and so I also have a discount rate of 0.9901. Okay. All right, so notice that I want that because on December 31st, I'm going to bring it back from January 31st, which is only 1 month. So notice that's 1 month at 12%. I believe this book always uses 12%. So again, they ask for the journal entries. Notice this is a fair value hedge, and not a cash flow hedge. So we're not doing both sets of transactions. And we generally do the cash flow hedge, and then we go through and say, oh, we need the middle one, etc. So I'm going to pause this while I get them side by side. Again, set up the regular hedge and the hedge side of this transaction so you can make your journal entries different. Okay, so notice in this one we have kind of two regular transactions. So I've got on my regular side, I've got a sale and I've got a purchase. So accounts receivable sales for the 500,000 times what it's worth today, 0.53. 265, and then inventory, and the last problem we did cost of goods sold because it told us to, but this one doesn't tell us to. So we have inventory and accounts payable for 300,000 times 0.53. So again, if you wanted to make T accounts of accounts receivable and payable, that might be wise because I'm sitting at 265. All right. Then on the hedge side, there's no entry because this is a forward contract, and I have no entries when I just sign an agreement. The next time on December 31st, okay, I'm again going to have two entries on the regular side. I need to adjust my accounts receivable from 0.53 to 0.50, so it's going down by 0.003. So times 0.003 times 500,000 is 15,000, so my accounts receivable is going down. Again, feel free to make a T account and put the balance of 265,000 and then what 200,000 times 0.50, 250,000, and I need to make it go down or credit it by 15,000. My accounts payable is sitting at 159 or 0.53. I also need it to go down to 0.50, so I'm going to debit my accounts payable by 9,000. 0.03 times 200,000, yeah. Okay, so I think I said 200,000, I meant 300,000. So on the accounts receivable, 500,000 sales times 0.03, and on the accounts payable, 300,000 in accounts payable times 0.03 is 9,000. Okay. Then on my hedge side, if this were a cash flow hedge, I would have 3 journal entries where I'd offset the gain or loss. You could technically do it with 2 journal entries or net the 2, but we have our forward contract was just one entry, so we probably would have netted them, although it really doesn't matter. Okay, so I would offset my gain or loss. I would adjust my forward contract to its fair value, and then I would amortize the premium or discount. In this case, it is a discount because it's lower by 0.010, but I'm doing a fair value hedge, so all I have is the middle entry. All right, so I asked myself, I need to sell foreign currency. Would I sell it for 0.52 or 0.48? I'd rather sell it for 0.52, so I'm better off. So I have an asset. So I'm going to debit forward contract and credit gain. Now I'm going to worry about the amount. And I know that it's 0.52 minus 0.48, so I have 0.004. 0.004 times 200,000 is what I've, my hedge is for, is 8,000, and so I have 8,000, but I'm making this entry on December 31st, not settling it till January 31st, so I need to bring it back 1 month, and that factor is 0.9901, so 8,000 times 0.9901 is 7920.80, or they do 7921. So I know I can put in my number now. The impact on net income, again, we've ditched the cost of goods sold part of the sale, so again, I would prefer they had just done that, but they don't. Okay, so the impact is 266,921. I would have said the impact on the foreign exchange transaction is 119,021. Okay, because I have a loss here, a gain here, and a gain there. Okay. All right, for 2018, my journal entries is first I have to adjust my accounts receivable and payable. So my accounts receivable is 500,000, and now it's gone from 0.50 to 0.49. So now it's gone down. Well, I guess it went down before, didn't it? So it's gone down by 500,000 times 0.01. That's 5,000. So I have a loss. My accounts payable was 300,000, and it's gone down. So I need to debit it to make it go down, and I have a gain. Now I'm going to go over to my forward contract, and again I'm going to take the whole entire difference instead of the 1 month in case it flips, and in this case it went down then back up, so it does flip directions. It doesn't necessarily flip it from an asset to a liability. So first of all I'm going to say, okay, well I could sell it for 0.52. Now I can sell it for 5.2. Now I can sell it for I could sell it for 0.49. I would rather sell it for 0.52, so I'm better off. But now I'm only better off by 0.03 instead of 0.04. So I need the 0.03 times the 200,000 that I've hedged. A lot of numbers going in here. And so notice it's still an asset because I'd rather sell it for 0.52. But if I made a T account of my forward contract, okay, if I made a T account of my forward contract, I would see that it has the 7920 over here, okay, 7921 actually is what they put in there. All right, and I want it to be 6,000, okay, want it to be 0.30. So now I have to credit it to take it down to 6,000, and so I'm going to take it down by 1,921. I don't have my 3 entries because this is a fair value hedge. I just have the 1. So I'm going to credit, this is my forward contract. That's what its value is. I need to credit it for that difference and debit loss. Then I'm going to settle the transaction. So basically I have 3 transactions going on. I have accounts receivable, accounts payable, and I have my forward contract. All right. So let's get the accounts receivable off my books first. My accounts receivable, if you had made a T account of accounts receivable, it's sitting at $245,000, which is also 500,000 times 0.49. I get the foreign currency. I also get the accounts payable off my books, which is 300,000 times 0.49, but also make a T account, double check it. I get it off my books, so I debit it, I get my foreign currency. So now if you net the foreign currency, you're going to see I've got 98,000 of foreign currency. Now I'm going to give it away. I get my cash. I sign my cash to sell my 200,000 times 0.52. Again, that's why I highlight this or put a square around it. And your forward contract should balance it. Notice my forward contract, I forced it to 6,000, and it is 6,000. And so I see my impact on my financial statements of just the gain or loss, and I am done.